Cashflow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
Hello, good evening everybody. Welcome to Oregon Cashflow Pro. My name is James Barber. I'm here to help you maximize your cash flow. How are you doing this evening? Hey, BDN. Good girls finish first. How you doing? Nope, you didn't miss it. Stalin, good evening. Been a long day. 3 glasses of red wine. All right. You're just getting relaxed then. You're just getting relaxed. So, this is our Wealthcare Wednesday live stream where we're here to try and answer all questions related to finance. Hopefully help you maximize your cash flow. And really anything else that we can do. But that is what we're here for. No stock market to watch while we're doing this live stream. Although if you have questions about it, you're welcome to bring it up. This is an open forum. So, how are you guys? How are you guys doing, guys and gals? What are you doing? I got a question for you. What are you doing to maximize your cash flow? Is there any particular strategies that you're employing or any particular products that you're using in order to maybe eliminate debt quickly, gain wealth, accumulate wealth? Anything in particular that you guys are doing? Go ahead and shout it out if it is. Personally, what I do is I like to do what's called dynamic banking. Although it's a bit of a challenge for me to do that these days. My favorite product to use to do dynamic banking with is a line of credit, a home equity line of credit. Costco, good evening. So a home equity line of credit happens to be my favorite thing to use just because we can get a really low interest rate and it helps to unlock some of the equity that's locked up in my house. And we use that for dynamic banking, although I refinanced my house earlier this year and I've not had the opportunity to get another Heloc. So we had paid off the previous Heloc that we had, and so I've been going without. And it is tough because I got used to using it. You get into a habit, and really within dynamic banking, this is what I hope everybody who practices gets in the habit of, is as soon as money gets into your hands, you put it right into the line of credit in order to offset some interest charges. So you're not wasting any of that money just sitting in a checking or savings account doing practically nothing for you. If you have debt out there should be a way that we can offset some of those interest charges and put those dollars to work while they're just sitting there waiting to do something else. Good girl says, very good. Moved from Brooklyn to Chicago earlier this year. Completely downsized. Hey, that's a great way to increase your cash flow. You live on 20% and invest the other 80%. Very nice. Very nice. That is a great way to do it. You can't go wrong. You can't go wrong doing that. So good for you. Good for you. Costco, I look upbeat with Tesla's recent scores. Love my energy. Wish me the best. Thank you. I appreciate that. I am upbeat. Doesn't have to do with Tesla. That's just me naturally, I hope. Try to bring some good energy to the live stream and to the channel. Tesla's doing really well though. Tesla's doing really well. I'm very happy about that. Stalin says, opinion on mortgage forbearance. You've been on the program for nearly a year. I think it's great. A lot of people needed that when we had the troubles with the pandemic. And it's a challenging time. The thing about forbearance that you got to watch out for is you want to make sure that it's not going to negatively affect your credit. What can happen is you could get, and I know a lot of rules and laws that are in place make it so that it can't. Okay, so that's good. But the thing that you got to watch out for is that they do note on your credit that you took the forbearance And you want to make sure that, they're not supposed to look at that and disqualify you for it. They're not supposed to hold it against you. Just got to make sure that that doesn't happen. You know, things can be fishy out there when it comes to people abiding by rules and regulations. But other than that, I have no qualms against anybody using mortgage forbearance if they need to. And even if you don't need to, if it makes sense for your financial plan, go for it. For the most part, the mortgage companies can handle it. The government is not really doing a whole lot for those companies, but they do provide them a lot of guarantees. So if you have an FHA loan, there's some guarantees in there. I think they'll be okay. And most likely, your payments that get the forbearance on, oftentimes those can get added on to the end of your mortgage. For some folks, you might have to come up with all of what you've put off right at the end of that forbearance. But I think most of the forbearance programs are adding it to the end so that you don't have to worry about that. So good luck to you. I'm glad you were able to get that, and I hope it helps you out. Hope it helps you find it easier to stay in your house because of it. Oliver, how's it going? Added 5 shares of Tesla. Very nice. Your mom added 73 shares today. Finally started her position. Nice. Hey, you got to start sometime. All right, good girl. Said, you mentioned earlier this week it's possible to lend yourself money with your insurance plan. Never heard that before. You're very curious about it. Yeah, so you're not necessarily lending yourself money. What happens is you create all of the life insurance policies that I design are high cash value design policies. They're meant to put a lot of money into them and generate a lot of cash growth inside that policy. By contract with these insurance companies, you can collateralize that cash value, and the insurance company is obligated by contract to give you a loan against that cash value if you want it. Now, there's a number of ways that you can actually collateralize that. You don't have to go through the insurance company. You can get loans against your cash value from a regular bank. A lot of banks have official programs in place that will allow you to do that. But a loan from the insurance company does have certain advantages to it. That loan does not show up on your credit. You don't have to qualify for it. They're required by contract to let you borrow against that cash value. And there's no repayment period. There's no set repayment period. So you don't have minimum payments that you have to make. It's unique in that way because they know at some point everybody passes away. We haven't reached the pinnacle medical achievement where that's stopped happening yet. So as it currently stands, everybody passes away at some point, and when you pass away, the first thing that the death benefit does is it pays off any outstanding loans that you have. And so you don't have to worry about it. And the insurance company doesn't worry about it. They just make sure that you don't borrow too much out of the policy. So you typically have access to 90 to 95% of the cash value within a policy. And a lot of folks use these for doing what we call infinite banking, which is you basically become your own banker. And these policies work just like a line of credit. Now, if they work just like a line of credit, why didn't I say earlier that those are my favorite debt tools to use as opposed to a home equity line of credit? Well, it's just a little bit slower to move your money in and out of a life insurance policy, sometimes a lot slower compared to a line of credit. The line of credit with a bank or a Heloc, you can typically move money in one day, or immediately. So you get access to offsetting those interest charges right away. Even if you have a bill due, let's say, in a couple of days, you can still offset interest charges for a couple of days. Whereas with the life insurance policy, at best it takes a day or two to get the money in and a day or two to get the money out. So you miss out on a few days of opportunity to offset those interest charges. Now, for those of you like me who don't have a line of credit that you can use at the time, but you do have a life insurance policy, in that case, you can use the life insurance policy. And that's what I do. So I every extra dollar that we get above what I'm comfortable having in the policy, right now I'm either putting it back into my life insurance policies so that I can pull it back out again later, or I'm putting it into the marketplace and I'm investing it because I'm having a lot of fun doing some day trading, and I have extra funds to be able to do that with. So those are what I'm doing with it. But yeah, hopefully that answers your question. That's amazing. It is amazing. It is amazing. And a lot of people just don't know about it. And so it's kind of my mission to spread the word and not only teach everybody about it, but everybody's welcome to sign up, have a meeting with me, a consultation. I can design a policy for you. We can talk about where it might fit in your financial portfolio. Really, that meeting we can talk about whatever you want. I offer up 20 minutes free to anybody for consultation purposes, but it's always free if you want to call and talk about any of the life insurance policies that I offer, because that's my main job. That's my main job, is designing those policies and selling them. I wouldn't be able to run this channel off of just what I get from the channel alone. I don't make enough. I don't make enough to do that. So I've got to supplement. This just supplements my income a little tiny bit, very teeny tiny bit. I do have to actually sell some policies, but as you'll see from my videos, and if you ever meet up with me, I'm not a hard sell. I do not do any type of hard selling. I educate on these products, and the products sell themselves. If it fits in your portfolio, great. If you want to work with me to develop that, even better. But none of that is required to dive down into this hole, watch my videos, learn what you can about it, or even have a meeting with me. None of that is required. My hope is to just help educate you so that you can help make better decisions in your financial life. Oliver, do you suggest life insurance or Roth for best play on investing? Why not both? There are ways to do both. There are ways to do both. So I do love Roths. I love Roths, but I also like to make sure that you've got your financial base solid, and that includes having some life insurance. Now, for some folks, that might be term life insurance because it's really cheap and they would rather just invest the difference. For other folks, that might be a cash value life insurance policy that one will provide the base, and you'll get some guaranteed growth in there, either with a whole life insurance policy or potential growth tied to a stock market index with an IUL. So there's a couple different ways that we can approach that. Those are my preference because we still have access to those funds. So you can put the money into the policy. You can then borrow it out and put it into your Roth. That's what I do. That's how I funded my Roth this year. Was I put the money into my policy first, borrowed it out of my policy, and then put it in my Roth. And that allows me to fully fund my Roth each year, and it helped me to fully fund my life insurance policy this year. So then when I get extra cash, I can pay down that loan that I took out of the life insurance policy. And now I still have money available in there if I need it, and I've got the money growing in the Roth that I can play around with and do my trading. So, Oliver, what's the worst scenario if you're using a Heloc? The worst scenario I can imagine using a Heloc would be if you borrowed out most of the Heloc in order to either put it in an investment or pay down another debt. I guess worst case scenario would be you've already paid down your debts, but you borrowed out of it in order to put into a Heloc, planning to do some dynamic banking with it, or you borrowed out of it and put it into an investment. And you did this planning to do some dynamic banking with it where we do paycheck parking. And so you take all of your paycheck and you put it into the Heloc, offset those interest charges, and then you pay your bills out of that. The worst case scenario would be, for some reason, the bank or the credit union that you have your Heloc with decides to reduce the line of credit that's available to you right after you put that payment in there, right after you put your whole paycheck in there. Because one of the keys to the dynamic banking concept is to be able to withdraw that money and pay your bills with it. So if you just put your money into it and the bank reduces your line of credit, now you can't pay your bills and you're going to be in trouble. So that would be worst case scenario. It's one of the reasons that we say you want to kind of pay attention to the world around you, because banks don't just do that on a whim. They tend to do that, reduce those credit lines if they're having trouble, if there's unrest in the overall market or the overall environment, something that's challenging their books and they're trying to tighten up. If you've been a good lender with them or a good borrower with them, they probably won't be reducing yours first. If you've had some struggles, maybe they will come after yours first. But if not, and they're not going to be coming after you first, there's going to be some signs that it might be happening soon. And, that could be maybe they've decided to stop giving out new home equity lines of credit. Maybe they've stopped advertising for other types of loans, right? I mean, you could build a relationship with one of the loan officers there and just let them know, hey, how are things going? The market might be a little rough right now. You guys still doing okay lending? And maybe they'll be able to let you know if anything is coming up ahead of time. So if we're doing dynamic banking with a line of credit and things do get rocky like that, and you might worry about them closing that up, what would you do? Well, what I would do is I would just borrow out everything from the line of credit. I would take the full amount that I could pull out. If we're in a rocky economic time, I would rather have that money, pay a little bit of extra interest to have that security of having that cash in my pocket, in my savings account where I can get to it, and not tied up in a line of credit that could disappear at any given time. So in my mind, it's always good to have a line of credit available because you're able to tap into that equity of your house if you need it. And they don't cost anything if you're not using it. For most places, they're just simply free. Some places might charge you a yearly fee, but for the most part, they're free. So if you don't need to use it, don't use it. If you do have a plan to use it to help pay off other debts or increase your wealth, utilizing dynamic banking, so much the better. But for me, I would much rather have the ability to access it than not have that ability. Nathaniel, how's it going? Top Gun, made it. Good evening, sir. Good girls. Can we talk more about that? How can I make an appointment with you? So you can make an appointment with me by going to my Calendly link. And I will put that in the chat here. It is calendly.com/cashflowpro. So if you go to that link, it goes right to my schedule. You get to see my whole calendar on there, and you can pick a time that works for you. So it works out pretty good. Oliver says, I have only my full-time job, 401k, and stocks. Looking to have 5 and more total streams of income. That's a good idea. That's a good idea. So we can consider the cash growth in a policy to be a stream of income. In my whole life policies, I get dividends because I became an owner of that company. That is a stream of income, and it will continue to grow throughout your life as you continue to fund your policy more and more. So I look at that as a legit stream of income, and it also is an awesome place to store cash. And when you know it, it provides a great death benefit as well. So it meets a lot of different needs when it comes to building that base of your financial pyramid. Let's see. Babber A, what are your thoughts on MPI account? Good question. So I've discussed this in at least one of my other Wealthcare Wednesday live streams, which you can find, and you might be able to find some more information than what I go over now, but I'll try and cover it. The concept I like the concept of it. The MPI account, basically what it does is it sets up an IUL, and it sets it up at a much higher level than what you would typically want to fund it at. And the idea is you're going to fund it at, let's say, $20,000 a year you want to fund it at. They may set the policy up at $60,000 a year that you could put into it. So you put $20,000 into it, you pay that for a couple of years, and then you can borrow out of it and put that money right back into it as new premiums in order to max out up to that $60,000. And I'm not too keen on how they advertise this MPI account because they're way too optimistic on the returns that it's going to provide. And the way that they pitch it to everybody, from what I've seen, with no caveats, they basically say you can make 12 to 15% conservatively. And I think that that's a bunch of crap. I think it's possible. I think it's definitely possible. You could possibly even make more than that on any given year. Are you going to be able to average that much? I don't know. It's going to depend on the stock market. It's going to depend on the indexes that you're tied to. It's going to require that you fund it how you're anticipating funding it. And it's also, and this is the big thing, it's going to require the cap rates or the participation rates that the insurance company starts off giving you. It's going to require those to stay high enough that you can earn those types of returns. So that's a lot of ifs that need to happen. Those are a lot of things that need to continue happening. And as we're seeing over the last 10 years, those cap rates have been coming down as insurance companies have been struggling to make good returns. So I think MPI and their whole approach to this totally ignores that possibility. I argued with Curtis on his channel about it. I said, look, you're not being very realistic here when you talk about this being a conservative amount. And he points back to the historical average of how these indexes perform as proof that his concept will work how he says it will work. But what he ignores is that none of those historical averages account for the insurance companies reducing those caps or reducing the participation rates. And that's where you can really get into trouble. So you got to watch out for that. Like I said, I like the concept because I love using leverage, and I do that in my policies. I pull money out and I put it back in as new premiums if I need to. That might be the best use of my money at the time because I may have other money tied up in the stock market. So I try not to have, when my premium rolls around, when my anniversary rolls around in my policy, one of my policies I pay $50,000 a year on. I don't just sit around with $50,000 a year in my checking or savings account. I put that money to work. So the number one place that I want to pull that money out of to put it back in and make that payment is one of my other policies that I have some cash value available in. That way I can keep my money working for me in other places that I have it working. So I love the concept. I'm on board with the concept. You just have to be realistic with the people that you're trying to sell these to. And I think that's where they fail. Yeah, he does a lot of advertising on TikTok. I've heard that. I'm happy to give you another perspective. Like I said, I think it's good. I think I design a better policy than they do. So if you're interested in something like that, check with me because there's nothing special about what they're doing. There's nothing special. They make it sound like there's a proprietary loan program or there's a proprietary there's this match that gets happened. It's the MPI match. There's no MPI match. It's just the money that's in your policy that they want you to pull out and put it back in. It's your money matching your other money. It's not MPI boosting your account with any extra funds. So I think it's a little misleading. In that regard. But if you read through the materials, which I did on one of them, it pretty clearly spelled out that the money is the money in your policy, the cash value available in your policy that you're borrowing out and putting it back into the policy. Now they like to, in their design, they say, pay a couple of years and then start pulling it out. And, they'll expand the policy a couple of years down the road and then you'll be able to pull out cash and put it back in at that point. There's no reason you can't do that from day one. I don't know why you have to wait a couple years. I think the only reason I can think that they would maybe want you to wait a couple of years is because it builds up cash value into your account and it's less likely to encounter problems if the index doesn't perform how you would hope it would perform. And because they don't talk a whole lot about that possibility happening, it's probably easier for them to just sell it as put the money in and take the next steps a couple years down the road. So that's my That's the feeling I got from it. That's the feeling I got from it. Oliver, is there any advantages in regards to Heloc if you're a first-time home buyer, or do you need to establish your credit history? You may need to establish your credit history. There's no advantages to being a first-time home buyer. Now, when you first get your loan, you might be able to work with your mortgage lender and set up a loan to begin with that starts off with an 80% first mortgage and a Heloc that's opened up for a little bit of the rest of the equity. So check with them because they may be able to get you started with something. That might be the best way for you to get a Heloc right off the bat. But otherwise, you typically have to have some credit history. They require usually about a 680 credit score, 680 or better. Now, if you're over 740, you can qualify for the top Heloc rates. Yeah, if you're over, I think 740 will get you the top Heloc rates. But each bank and each credit union or each lender has their own requirements. You know, what they like to see from any particular person. So just look into it. Yeah, but I don't know of any advantages to being a first-time buyer. If you can get one, just get one. Stalin, is there different angles you take with clients which live in different states? Sure. A lot of it will just depend on your overall financial situation. So it doesn't necessarily make a difference in as far as which state you're in, but there's definitely different angles for different clients. If some clients may not have any savings built up, maybe they have an emergency savings built up, but they don't have any investments. In my opinion, they're primed and ready to still finish building the base of their financial pyramid, which would mean let's look to a whole life policy, something that can get you some guaranteed growth, that you could put that savings that's just sitting in a savings account, might be your emergency fund, but it's not earning hardly anything. It's just sitting there waiting to be used. And, it does that job well, but it's only one job. We can make those dollars do multiple jobs by putting them into a policy. Now you get death benefit. You have access to it, so you have the liquidity you need to be an emergency fund, but it also has guaranteed growth. So it does a number of different jobs for you. And the sooner we get it in there, it's going to compound for the rest of your life. So it's a great idea to get these started as early as possible. Other folks, maybe they have some life insurance already. Not too worried about the death benefit. Maybe they have some money in investments, but it's all very aggressive investments. They don't have anything that's growing in a safe environment. Maybe then we look at an IUL to provide some of that safe environment. So rather than splitting up your aggressive portfolio and turning it into, what's a non-aggressive portfolio? 60-40, 60% stocks, 40% bonds, 70% bonds, 30% stocks. As you get closer to retirement, you're going to kind of move into a more and more conservative portfolio. Well, if we have the conservative side of your portfolio handled because of the IUL providing you protection against any downsides, but it still provides you with a lot of upside potential, maybe you can be more aggressive in your other investing. So that could serve a place in a portfolio to take the place of maybe some bonds or money markets or whatever you are thinking of doing that's providing some more safety in there, but takes away your growth potential. So that works good in that sense. A lot of different ways we can approach it. And yeah, we just go client by client and figure out what's going to work best for you. Top Gun would really love to see a comparison between MPI and premium financing. What would make more sense financially speaking? Premium financing would make more sense financially speaking, just because it's a lot higher amount. MPI, it's very similar, but MPI requires a lot more of your personal funds. Although it depends on who you go to for premium financing. Premium financing could also require you to put up collateral as well and contribute some. So they're very similar, except with MPI, you're likely borrowing from the insurance company, so you're probably borrowing at a higher rate than what you would get for most premium financing cases. The advantage of going with premium financing is you can usually get a really, really low interest rate in comparison to getting it from other places. So I would say the advantage would be premium financing. But MPI would really be more towards a lower policy amount also than what premium financing is targeted at. Although, you don't need to qualify for premium financing to do MPI or to do that strategy where you're pulling out the cash value and putting it back in. You just need to qualify for whatever account you can qualify for, whatever insurance policy we can get you qualified for. You don't have to qualify for this huge, giant $10 million, $20 million, $50 million death benefit. Premium financing is really for folks who make a lot of money and are planning on having a very, very large death benefit. Now, there is an advantage to MPI that you don't get from premium financing. When you're doing premium financing, all that cash value in your policy is locked up until you pay off the bank or the lender who did the premium financing. They don't let you access that cash value. If you're doing MPI or something similar to it, you are still the one in control of all of the cash value. Now, you're going to have a lot of loans out, but whatever cash value you create, you have access to it. So there is that difference there. Babber A. So I just have a term life yearly through work. Was interested in getting a set 20 to 30 year term life, but went down the rabbit hole of whole life, then IUL, then MPI. Paralysis by analysis. Yeah, I get that. Feel free to set up a meeting with me. Let's talk about it. I might be able to help you get past that paralysis and do so in a way that does it with the data. We'll look at the numbers and see what may work out best. A lot of it's going to have to do with your tolerance for risk and also your habits. Like, you and what would you do if you did term? What would you do with the extra money that you saved? Like, is term and invest the difference a reality for you? Because a lot of people, they like to say, just buy term and invest the difference. Well, a lot of people buy the term and then they don't invest the difference. And so at the end of the term, they're still in a bad position. Like, they didn't get necessarily into a place where they can self-insure, and now they don't have a death benefit either. There are ways to utilize IULs or whole life to give you the death benefit that you're looking for and the ability to do the investing that you need. So it doesn't necessarily have to be one or the other. And the way I typically view term is a straight expense. The only way it's not going to be an expense is if you actually die during the term. But if you don't, you just spent all that money and you didn't get anything out of it because there's no cash value growth from it. Now, one could say what you got out of it was the peace of mind, and possibly that allowed you to be more aggressive in your other investments. Okay, maybe so. But if we go with the IUL or whole life policy, you do get actual cash value growth. And if the growth in those is higher than it costs you to put into it, which that's how we design it. We design it with a very early break-even period, like 3 or 4 or 5 or 6 years, depending on the product and the design you go with or how you're funding it. It can break even pretty quickly, and at that point, you're dealing with house money. And you can borrow against that to do your investments still as well. So you don't necessarily have to choose when we're using those products. We can kind of do everything that we want to do, and it elevates our other investing, in my opinion. So Top Gun says there are different tools for different jobs. Whole life is the basis or bedrock of a sound wealth retention and generational wealth. IUL shifts risk back to the policy owner, possibly higher returns, but introduces higher risk. Yeah, that's a good way of putting it. The IUL, it does shift more of the risk. Well, it does shift risk onto the client as opposed to having the risk on the insurance company, which is what the whole life does. Whole life gives you guarantees. Well, those guarantees do cost money. So when we take away some of those guarantees, like we do with IULs, what we end up with is a less expensive underlying product. So we, in turn, because it's less expensive underlying, if we're putting in a bunch of money, we have a greater ability to get gains with those funds. So that's the trade-off. That's the trade-off. And for what's going to work best for your situation, we just got to get together and talk about it. Because the answer is not going to be the same for everybody. There's no blanket right answer. Stalin says, let's see, is there different? Oh, New Jersey. New Jersey. I have a lot of clients in New Jersey, surprisingly. One of your biggest handicap is the money in your savings. You're overly conservative with it. Yeah, there's no problem being overly conservative with the money in your savings. You should be. You should be. That's where whole life comes in. Whole life has guaranteed growth. You know what the premium payments are going to be. Those don't change. So the underlying costs don't increase as the policy gets older. You have a locked-in death benefit. And basically what you're doing is you're creating a nice conservative savings asset that can replace a savings account. So it's a great place to save your money. Great place to save your money. And we can set it up to just absorb a certain amount. So we can set them up to be just as much money as you want to put into it. So let's say you have $100,000 that you like to have for an emergency fund. Maybe you make good income and that's 6 months of your income, right? Or 6 months of your expenses that you set aside. It ends up being $100,000, okay? We can design a policy that over a few years will absorb that $100,000, and that's all you ever put into the policy. And you can look and see exactly how that thing is going to grow, or how we presume it's going to grow based on the dividends. But there's guaranteed growth in it as well. So you can see at minimum what is the best that this thing would do just by putting in that money that's just sitting in your savings account otherwise. And you'd be surprised. It's well worth it, and it's still available if you need it in an emergency, which is the key reason for having the money in the savings account, right? The other bonus from that, though, is the money that's available in your policy is protected from creditors, whereas your savings account is not. So there are some other benefits there as well beyond just having access to that cash value. Top Gun. MPI is simply taking advantage, leveraging permanent insurance to buy more insurance. Nothing radical here. You can find banks that will give you a line of credit against your insurance policy at a good interest rate. Ding, 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 ding. Yep, that's exactly right. Oliver, if I was trying to move money from life insurance to Roth, is there an interest? Yes. Is there a charge? Yes. So when I talk about how I moved money from my insurance policy to my Roth account, the way that we access that money that's otherwise locked up in our life insurance policies is by collateralizing it. We don't borrow money or take money out of our policy because we want it to stay in there compounding for the rest of our life. What we do is we borrow against it. So we collateralize that cash value. And the insurance company is required to let you borrow against it. So that's what you do. You just borrow against it. Now, you don't have to borrow from the insurance company, though. Like Top Gun pointed out, there are banks out there with formal programs that will let you, they'll basically create like a line of credit that's collateralized that life insurance cash value. The same as the insurance company collateralizes it. The only difference is they'll typically have a required monthly payment. Like you might have to just pay the interest on it. Although some even don't have that. I think some of them will even let you just do whatever you want. Like it's not a very long time period that they do those for. So it might be like 2 to 5 years that they'll give you a line of credit against your cash value, and then you'll have to renew it. And so at that point they'll just reassess. But you may or may not have payments in between there because they know that policy is growing along with it. And it's like tier one type of asset, life insurance cash value is. So it gets treated as such by the banks. Oliver, what's the minimum to hold money in life insurance before you can take it out? Just above the cost of the insurance. Above the cost of the policy itself. Everything you put in above the cost of the policy should be going to cash value if it's designed properly. And it can be substantial, like 50 to 90% of what you paid into it can be available to borrow out the first year. And the reason I go down to that 50% is because if you just do a very small policy, you might only have 50% of it available in cash value. If you do a really, really small policy, which I do on some kids, where it's like we put in $100 a month, there probably isn't going to be any cash value available that first year, but the next year there'll be cash value available. But we're talking $1,200 a year policies that wouldn't have any cash value. At $3,000 a year, like I did with my girls, I had about 1,100 available, 1,100 to 1,200 available that first year. So the higher we get, though, the more percentage-wise we end up seeing available. And really, with whole life policies, I can get 80 to 87% cash value or so, somewhere around there. Although with an IUL, there is an additional rider that you can pay for. It's called an enhanced liquidity rider that will make all of the cash value available at the beginning. It costs a little bit, so it reduces the cash value in the policy that's growing based on the index, but there's no surrender charges with that. So it does free up and to make available probably over 90% going to be available. So a lot of different ways we can approach it. Oliver, life insurance is basically money where it can grow slowly, but it's also liquid anytime. Life insurance is multi-purpose and dynamic. Yes, you got it. You're starting to understand. So yeah, that's well said. I have nothing else to add as far as that goes. Any other questions? Babber, what are some of the top whole life IUL companies you work with? Whole life, I like Guardian for their flexibility and the ability for me to design policies that we can put in large percentages of our income. Guardian is like the most flexible when it comes to being able to do that, as far as the whole life policies go. And they also give us the ability to put in small amounts and catch up later down the road. They give us the ability to commit to very small amounts, but put in all the way up to the MEC limit throughout the year. Mass Mutual and Penn Mutual, I like them as well in the whole life realm, but they're less flexible than Guardian. They want to know, they want to know exactly what you're putting into the policy each year. Whereas Guardian, we just tell them the minimum amount that we're going to put in each year, and we can put in as much as we want. With Mass Mutual and Penn Mutual, you want to put in above what we tell them, they're going to probably ask for some underwriting. So a little bit different what we can get qualified for, as at least compared to what your income is. They're going to have some stricter requirements. When it comes to so those are my top 3 for whole life policies. For IULs, Allianz is my number 1. Number 2 is National Life. Other ones I would consider, probably Nationwide and Transamerica and F&GL, Fidelity and Guarantee Life. So by far, though, that Allianz one is the best when it comes to cash growth potential. So cash growth potential, that Allianz product, there's a few reasons why that one's the best, in my opinion, right now. The index options that they offer. They have 2 of them that are uncapped, and they're volatility indexes. They have very, very good historical returns, and I don't see that changing. You don't see that changing too much in the future, just because of their underlying design, being actively managed index funds. They're not proprietary. You can Google them and you can see the results of this index fund. So I like that. I like that it's not a special proprietary index that was created just from that insurance company doing some special back testing method that may or may not play out at all in the future. Not the case. This is an actively managed index fund that's separate from this company. They don't control it. So I like that. But what they do offer is a high participation rate, 145% currently, along with a guaranteed bonus option that's available. You can do either a 15% bonus that has no charge to it, or you can do a 40% bonus that you take on a little bit more risk with. It has a 1% asset charge. I utilize that one. I utilize the 40% bonus, and I pay that 1%. It looks well worth it to me in the long run with the extra growth that could be available from that. Beyond that, they give you the ability to lock in the rate, to lock in the growth on that index. There's two of them actually. There's two of them, but you get the ability to lock either one of those. So in my policy, when I open up my policy, I can see online the value when I started it, when I put the money in. So I got my starting segment, and I can see what it's currently at. And then right next to that is a big blue button that if I push it, I can lock in whatever those gains are. Now, when would I do something like that? You can only lock it once a year, and you can't undo the lock. So when would I maybe do that? Well, let's take 2020, for instance. If you have an anniversary date, if your segment period would normally end in, let's say, April or May, and it's currently February, your index is up about 8%, but you're hearing about this COVID thing, and you're unsure. Everybody's getting a little nervous. What is that going to do to the economy? What's it going to do to the stock market? Well, as it turns out, it killed the stock market in March, and it didn't come back up until mid-May or so. So if your anniversary was in March or April, you would have gotten a 0% return that year. But luckily for you, you went with Allianz. You have the ability to lock in that rate, and you decided in February to lock it at that 8%. You lock it at 8%. You multiply that times the participation rate that you get, which is 145%. Now you're up to 12%, right about 12%, a little bit less. And then you get the 40% on top of that. Are those numbers all right? Yeah, you get your 40% on top of that. So you actually, what you get credited that year is going to be close to 16%. Whereas if you didn't have the ability to lock it, you would have ended up with zero because you would have been right in the middle of the downturn in the market. So having a little bit more control over the index, I really like that. I really like that. Top Gun, thank you for the tip, my friend. Much appreciated. Much appreciated. Oliver asks, does life insurance include indexes just like a 401k? Sort of. Sort of. They do have some indexes. So in your 401k, you typically have a wide variety of indexes you could choose from. Life insurance typically offers a handful. Allianz offers about 15 different options that you can do, but some of them are repeated. Some of them just have a bonus associated with it, and some of them don't. Otherwise, it could be the same index options, just different cap rates or different participation rates. But for the most part, you can always use an S&P 500 index. That one is almost universal in every IUL that I know of. And then there will be some other ones to go along with that. Some of them will do blendeds, where they'll do a mix of different indexes. Some of them have like the Euro index. Some of them have some high cap, ones that are made up of high cap or large cap or mid cap. So there can be a number of different ones, but nowhere near the variety that you might see in a 401k. Babber, so glad came across the channel. I'm the most honest and straightforward agent you come across. Look forward to setting up a meeting with you. Thank you. I appreciate that. For me, my shtick is transparency. It's all about transparency. And when it comes to policy design, nobody beats me on policy design because my commitment is to design the best policy that I can for you and minimize the agent's commission. So you will never have to come back to me and say, hey, Is there any way we can make this better? Because it's going to be the best it's going to look when I design it. There's not really going to be, unless it's a product that I don't know, and I'll tell you if I don't know about it, or if it's a product that I don't sell or I don't have any experience with, I might not be able to help you understand it if you're asking me for advice on a different one. But if it's one that I'm familiar with, if it's one that I sell, if it's one I'm designing, it is going to have the best design on it, because I don't mess around. I'm not here to try and pull every dollar out of you and put as much of those dollars into my pocket as I can. What I try and do is spend my time educating you guys, letting you know how to design these policies yourself so you know what to look for, because I can't service everybody. Okay? As much as I would love to sell everybody in the world a life insurance policy and get filthy rich, it's not possible. I just don't have the time. I don't have the capabilities to service everybody. So, and also maybe some people maybe they just don't like me for whatever reason. Maybe it rubs them the wrong way. Maybe they're just more attracted to a different type of personality. Maybe they need somebody who's going to do a hard sell in order to get them off the fence, right? So they may meet with me and like me just fine, but then they meet with somebody else just to get a second opinion, and for whatever reason their style works better as far as getting them to commit and make a commitment and finally start the policy. Okay, great. No big deal. Wherever you end up is fine with me, as long as you know how a policy should be designed and you're able to get one that's designed well for you. I'm pretty happy. I don't have to be the salesperson for everybody. And in fact, I hope the channel does better and better so that I can spend a lot more time educating, and I have to worry less about actually selling any policies. That would be ideal scenario for me. Not that I don't like it. I like doing this stuff. But I don't like having to rely on doing. I don't like having to rely on it. I mean, we all like to have passive income, right? We all like to have some passive income. Stalin, definitely going to look into setting up a meeting. Appreciate your approach on offering your services. You're welcome. You're absolutely welcome. Oliver, the amount of information and advice you give is gold. Watch your live videos every day. Always learning new things. Thank you, Oliver. People would pay thousands for the same advice. And they do. They do, just not to me. They'll pay it to somebody else. But often it's because they haven't learned yet how to save those thousands. Top Gun, when using a rate lock with Allianz, does the credit apply to your entire cash value plus death benefit for the entire year? Not sure what you mean by plus death benefit, because your indexes the credit you get doesn't ever apply to your death benefit. But yes, it would apply to, I can't even say it would apply to your whole cash value, because what can happen is let's say I put money in January, and then I put more money into my policy in June. I'm going to have two separate segments. So I'm going to have a segment that starts in January and ends the following January, and I can lock that segment. And I'm going to have another policy, or I'm going to have another segment that goes from June to June, and I can lock that one separately. So you should be able to lock each one separately. It's not push the button and they all get locked, because that would really mess things up. That would really mess things up if one segment had just gotten started and another one was just ending. That wouldn't work out too well. So it would apply to whatever cash value you have assigned to that segment. Top Gun. Also, let's say a huge rally occurs. You're looking at a high double-digit return. Is that applied for the full year? If so, that's incredible. Yeah, it would be applied for the full year. So the way that it works, so like I said, in our example, if your anniversary is in April, you make it all the way around, and you've got an 8% gain in February. Although in your case, you say double digits. Let's say you got a 10% gain. You can lock it, and whatever it is, I mean, you can lock whichever segments you want to lock that have the gain that you want to lock in. So yeah, huge rally occurs. I mean, if that huge rally occurs in 2 months after your segment period starts, sure, you can lock it in then. You don't have to wait, because it's certainly possible that after that huge rally, what happens? Things drop down. So you could certainly lock in at any point. The main thing to realize is you can't unlock it. So you want to make sure that you're going to be happy with that lock, because if you lock it, let's say huge rally occurs, you're up 16%, and you lock it, and then it rallies up some more to 20%. Well, you're still locked at 16%. So you just don't get FOMO. Once you lock it, just come back at the end of the next segment period, or come back at the end of that segment period and see where you get to start again. Don't get yourself down that you locked it too soon. Just be happy that you got some solid gains. Oliver says, before this channel, didn't know much about life insurance and policy, didn't know how dynamic it was. It's like having a lot of tools in the tool belt at your disposal for any situation. That is a great way to put it. It is exactly like that. When it comes to your whole financial life, you don't only have one tool in your tool belt. You don't have just a hammer to do every different job. The life insurance policy would be more like a Swiss Army knife, but like a very high quality one that can do a lot of different jobs, right? And it's not going to break. So that's a good analogy, having a lot of different tools in the tool belt. All right, looks like we're caught up on the questions. I need a drink because my voice. Still struggling a little bit. Been doing a lot of talking. Time for Tesla stock talk, he says. Yeah, I mean, if you want to talk a little bit about that, we can do that. I noticed it went up after close. Top Gun, your death benefit never increases with the IUL. No, it does. Your death benefit does increase. So it depends on what type of death benefit you're using. With the designs that I do, we use an increasing death benefit. So as your cash value goes up, your death benefit goes up exactly the same amount. But the underlying cost of insurance doesn't go up based on that, because the underlying cost of insurance stays the same. So your cost is based on the difference between cash value and the death benefit. That's your cost of insurance. And so as your cash value goes up, your death benefit will go up the same amount. But you don't apply, the credit doesn't apply to the death benefit. So if we were to consider, say you got a 30% return 1 year. You had $100,000 in cash value, $200,000 in death benefit. You're not going to get $30,000 for cash value and then $60,000 on your death benefit. That would be a 30% credit on both of those. But what you will get is you'll get $30,000 on your cash value, and that will increase your death benefit by $30,000. The same exact amount. Okay? Does that make sense? Yeah, it's not independent of returns. It can be kind of independent of returns if you use a level death benefit. So a level death benefit, which is an option out there, I just don't design them that way because the people I work with, we're designing it for cash value growth. When we're designing it for cash value growth, we want to have the minimum cost of insurance, and we get that from an increasing death benefit, because we can start out with that lower death benefit, and as the cash value goes up, the death benefit goes up right along with it, the exact same amount, and it keeps that same death benefit difference. With a level death benefit, you're going to start off with a higher death benefit, and as this goes up, they eventually will meet or get close to meeting, and at some point, they'll start to grow kind of together in order to maintain the corridor of insurance, as it's called, so that it doesn't become a modified endowment contract. But with that type of policy design, your insurance costs when you first start out are a lot higher because you're paying for a lot higher death benefit. So what that does is, yeah, it gives you a higher death benefit, but it increases your costs. So ultimately, down the road, you're going to have less cash value at the end of it. David, yeah, I'm back. I'm always on here. I figure tomorrow the market's closed, but I'll be on for a little bit tomorrow too if people want to talk strategy. Figure out a plan for the rest of this squeeze that we're going to put on the indexes with Tesla or any other stocks. Really, it'll be open. No, I didn't end it early today. I ended it when I should be ending it normally, which was about 8:30. Because I usually have meetings that start at 9 o'clock. It's just some days I go later if my meetings don't start a little bit later. So, Oliver, what other insurance would be equivalent to life insurance? Not sure what you mean by that. What other insurance would be equivalent? I don't know of any other insurance that would be equivalent to life insurance. Like your car insurance, there's no cash value that builds up in it. Homeowners insurance, there's no cash value that builds up into it. So I have a hard time finding an equivalency there. Other insurance would be more like the equivalent of term insurance, where you pay your premiums and you only get a benefit from it if you need to file a claim. In the case of term insurance, that claim would be when you pass away. Although National Life does offer living benefits with their term insurance. So you do have access to the death benefit before you pass away with National Life's term insurance. So other than that, though, I don't know what kind of equivalency I would say. So hopefully that answered your question. Apollo, how's it going? Top Gun, did you see Dave Ramsey attack IBC? He said some weird stuff. I did not. Is that something recent? I'm going to have to look that up. I mean, Dave Ramsey, he's good for eliminating debt stuff and for getting people in the right mindset, I think. At least some of the right mindset. But he completely misses when it comes to life insurance. And it seems like he's had a bad experience a long time ago with a whole life product that was designed poorly. Otherwise known as your traditionally designed whole life insurance policy. And it didn't work for him. Didn't grow value for him, and ultimately he thought it hurt his financial plan. And so he's done nothing but talk crap about him ever since. That's what it seems like to me. Nothing he addressed, none of the concerns he addresses match the type of policies that I sell or the design that I sell. But I can see how all of his criticisms are valid with a poorly designed policy. Except when he says, I think he says this, you don't get the death benefit and the cash value. You do actually get both of those things. You do get the death benefit and the cash value in pretty much every policy that we have. So with the increasing death benefit, as your cash value goes up, your death benefit goes up. But what you pay for a death benefit does not go up. It's only that corridor of insurance. What gets paid out to your beneficiaries, it's all going to be called death benefit. That way it's tax-free. But they're getting that cash value plus however much insurance you want to pay for throughout the life of the policy. So they're getting both of it. Top Gun says, Dave Ramsey did a video yesterday. Totally agree with your assessment of him. He's completely off with insurance and investment advice. Dave says, how are you? Is he talking about whole life and things like that? Yeah, I think you must have been talking to Top Gun. Yeah, I think that's what he was talking about. Dave says, Dave Ramsey's way of investing is keeping your money in a CD at the bank. No, Dave is a big fan of some mutual funds that always earn 12% interest, wherever you can find those. I think you'd be hard pressed to find those, but that's his shtick, it seems. He's always comparing the potential returns that you get somewhere else with a 12% mutual fund return. Stalin says HBA. I'm not sure what you mean by HBA or what that comment is supposed to be. BDN, in terms of buying stocks, using the IRA, Roth IRA accounts, or just a brokerage account plus tax is better. Good question, but it depends on what your goals are. So there are different reasons to use each one of those, actually. My preferred one is the Roth because it's going to grow tax-free and any gains inside of it. And if you're trading yourself and you're getting really good returns, not just passively investing in an index fund or an ETF, the Roth you can get really, really good returns on it, and you don't have to worry about paying taxes down the road. IRA, great one. It's all tax deferred, so you get to start out with more money, but you are going to end up with higher taxes that you're going to pay out at the end. Just using a brokerage account, there are different ways to approach harvesting your gains from a traditional brokerage account. But you are limited on some things. So like if you're selling covered calls or you're getting dividends, things where you're getting regular income out of it, you're going to just pay regular tax. And there isn't really any advantage to doing that, except if you're paying a tax, at least you're gaining money. You're not going to pay a tax if it's losses. So on the plus side, at least if you're paying tax, you made money in the account. But there are ways that you can get the money out of that brokerage account or harvest the losses. There's a thing called tax loss harvesting. There's capital gains rates, which if you hold it long enough, if you hold it stock for longer than a year, any gains on it will get taxed at a capital gains rate. And depending on where your actual earned income rate is, that could be 0%, it could be 10%, it could be 15%. So different approaches to different types of accounts. BDN says CD rates are not great right now. Yeah, they're not. They're really not. Top Gun, correct about his weird comment about losing cash value at death. Just weird. It's like he hasn't done the math. Yeah, it's like he hasn't done it, or it serves his purposes better to ignore it. Because most of his show is about selling things that he wants his clients to buy, and there's people that pay him handsomely to be the ones who are going to be the recipients of those products. So the life insurance company that he recommends to go buy the term insurance from all the time, he's getting something from that. So I think there's a reason he directs people the way that he does. Top Gun, 12% mutual fund is a myth. Yeah, pretty much. I mean, one that you can get 12% every year without fail or on an average, yeah, probably a myth. Although there are some funds out there that do very well. Just look at ARK Invest. We got some great returns there. But who knows if she'll be able to keep that up for 30 years. Oliver, do I like Ramsey or Kramer more if you had to choose? I don't know. I'd probably rather listen to Ramsey. I do like what he has. I do like a lot of what he has to say. And Kramer has that a voice that just kind of grates on me a little bit. But I don't really listen to either one. So although I think I've listened to Ramsey more if you add it up. I've listened to him a little bit. I just don't actively listen to either one of them. David says, don't believe in Roth IRA, your taxes will be lower in retirement. I don't believe in Roth IRA, your taxes will be lower in retirement. Not necessarily. Not necessarily. It depends on how your investing goes. For one thing, there's a couple of things to consider when you're thinking of the differences between a Roth and a traditional IRA. With a traditional IRA, you're going to have required minimum distributions at some point if you have a large amount of money in there, which means after age 72, you're going to have to start pulling money out, a specific amount, whether you want to or not, and you're going to be paying taxes on it when it comes out. With the Roth, there's no required minimum distributions. The other thing is depending on how you're getting your growth in these policies, it's not necessarily going to be equal. You can grow what's in your Roth a massive amount if you're doing the right trades, right? And you're going to get way more in tax savings than had you started off with that same amount of money in your taxable account and then did all of those same moves. It does not work out to be the same. I mean, unless if you go through and you do the math and you give yourself the exact same amount of returns, like you started off with 30% more in your IRA than you did in your Roth, and so your gains every time you made a gain ended up being 30% more, and then you got taxed at the end. Yeah, I mean, maybe it would be equal then, but odds are it's not going to quite work out exactly that way. You know, your gains are not going to be even. And so I would just rather, I would rather take the hit at the beginning for most of it, depending on what tax rate you're at, of course. I mean, if you're already at the top tax rate, maybe you don't want to do the Roth. Maybe you don't want to do the Roth first. Maybe you do the regular one. But when you're young, and Oliver's young, Oliver's in his 20s, if you're young and your income is at a low tax rate, pay the tax and invest in your Roth. That's my suggestion. If you're older and your income puts you into a higher tax bracket, now you got some decisions to make. Putting it into a tax-deferred account may end up paying dividends. It may reduce what tax rate you're in to this year, and maybe you'll be in a lower tax rate at retirement. But, I mean, do any of us really want to be making less money in retirement than we are now? I don't think we want to be in that position. So, how do you want it to be taxed with what you make in retirement? How do you want it to be taxed? For me, I'd rather it not be taxed. And you can guarantee it's not taxed if you do a Roth and if you do life insurance policies where you just borrow the money out when you get to retirement. Those are two ways that we can get it out. If we have those ways to get money out tax-free, then we can certainly plan on pulling out money from taxed environments, so your traditional one. And we can do it in a controlled manner so that we're not paying too much tax on it as it comes out. So, Stalin, HBA, healthcare. Oh, I'm not sure what HBA is. I'm used to HSA and HSA. There's definitely some good tax benefits for using an SHA. Let's see. Hey, David, put that towards my silver bar. Thank you. I appreciate the tip. I'm not going to be buying a silver bar, though. Still not buying any silver bars. But I much appreciate that. Babber, thoughts on taking out money from 401k via CARES Act, moving it into an IRA with an intent to convert it to Roth IRA in the future. Also gives you access to invest in individual stocks like Tesla. I like it. I like that. So for one, I'm a big fan of getting money out, if you can, via the CARES Act. Because you have multiple ways of paying the tax with it. You can, well, if you want to pay the tax, you don't have to. You can take 3 years and you can put the money back in. You can take 3 years and pay the taxes, a third. You can't just wait 3 years and then pay the taxes, but you can pay the taxes over time. And that gives you time to get growth in your policies or in your other accounts, your other investments that can pay those taxes. So really a good way to do it, I think. Really a good way to do it. Now, you don't necessarily need to move it into an IRA from your 401k via the CARES Act, unless you need that in order to pull it out. So some employers will not let you take out of your 401k unless you quit or you have another event that qualifies for it based on however they set theirs up. So if you need to do it because the CARES Act lets you do it, I think it's a great time to do it. It's a great time to do it. And you don't even have to move it into your IRA first and then put it into your Roth. But you can. Just got to make sure you qualify under the CARES Act, which at this point most people do. David says it works out the same in the end. And yeah, not quite. I don't think it works out quite the same in the end. Because you're going to make different decisions You're going to make different decisions. And at the end, yes, if we go strictly with the math, if you have the same tax rate now that you have in retirement, yeah, the math says it's going to be exactly the same. But I don't think that, one, you're guaranteed to have the same tax rate in retirement. Could be higher, could be lower. And two, I don't think it's going to grow. I don't think it'll grow the same. I don't think it'll grow the same. Top Gun says, there is a way to partially convert from traditional to a Roth and pay very little tax. You should consider that if your annual income varies from year to year. Yep. BDN says the Roth has a $6,000 limit in terms of distribution. Not in terms of distribution, but in terms of being able to contribute each year. It has a $6,000 limit. Unless you're over age 51, I think it's over age 51, and you can bump it up by a little bit. It's either 6,500 or 7,000. I think it might be 7,000 this year that you can put in. And do catch up. So you might be able to put in a little bit more than 6,000. And then you're also limited based on your income. So if you make more than, I want to say somewhere around 90,000 as a single person, then you don't get to contribute to a Roth. And over 180 or 190,000 as a couple, as a married filing jointly, you don't get to contribute to a Roth. So you got to watch out with what you contribute. And if you don't qualify in those senses, then you can do the backdoor conversions from a regular IRA into a Roth. Oliver, is the tax write-off huge if you own more than one property? It can be. It can be very big. You get to depreciate. You get to depreciate rental properties. And that can be pretty substantial, especially after the Trump tax cuts in 2017. They created some accelerated depreciation that you can get as well. And then there's other methods depending on what type of property you own. There could be what do they call it? It's on the tip of my tongue. Top Gun knows it. I'm sure he can weigh in. It's where you can take all of the property within the property. So if you buy a multifamily, you can add up and depreciate quicker all of the things that are property. Cost segregation analysis. Thank you. I knew it had to do and started with an S and it had to do with something with segregation. Cost segregation analysis. So what you'll do is you'll take like the cost of the fixtures. Those can usually be depreciated on a shorter time frame than the overall building. So your building may be depreciated over 27 years or 40 years. And cost segregation analysis allows you to depreciate the electrical, the plumbing, the wiring, the lighting, any furniture, basically anything else that you can that is on a shorter time frame. You might be able to depreciate it in an accelerated way, maybe in year one, but then also above and beyond that, you might have a 5-year depreciation on some things, 15-year, 20-year, whatever they would normally depreciate at. So it doesn't all have to be depreciated over the full 27 years or 40 years, whatever the typical depreciation rate is for that building. Let's see. Oh yeah, Top Gun says not in a Roth 401k, only a Roth IRA. Yeah, Roth 401k you can contribute larger amounts. You can contribute much larger amounts. David says, yeah, IRAs below age 50 are maxed at $6,000 per year. How much can you fund it per year in 2020 and 2021? Oh, they're maxed at $6,000 per year. How much you can fund it? Yeah. Yep, you're right. In retirement, you will not work, so you'll be at 15% tax bracket, assuming you retire with everything paid off. Not necessarily true, because if you're pulling money out of your retirement account and you have to pay taxes on it, it's taxed as earned income. So you're not going to be in the 15% tax bracket if you pull out $200,000 a year out of your retirement account. Oh, you think it's 120K for a single person for cutoff for the Roth IRA? That sounds a bit high. That sounds a bit high. Let me do a quick Google search. Roth IRA income limits. Here we go. Hey. They're up a lot higher than I thought it was. So even yours was low. It's under 137,000. No, 139,000 for 2020. Under 139. And for married, it's 203, 2019, 206 for 2020. Wow, how long has it been since I've looked at those numbers? It must have been a while because I was still back in the when it was 190 something. Thanks for bringing that up and making me look it up. We're all here to learn something new, aren't we? Oliver, will you enter multifamily investing properties? Sounds like a rewarding task, but I heard you are the go-to person for all problems, including fixtures, plumbing, etc. Yeah, not really. It depends on how big of a property it is. If it's a big enough property, you hire people to do that work. Also, for the most part, you would probably hire a property manager anyways. You do not have to be your own property manager. There's people that do that. There's people that get paid for that. And it does take a load off. So I do plan on investing in some multifamily properties soon. Hopefully some triplexes or quads. That's my hope. And Top Gun's going to help me out with that. Top Gun is, for folks that don't know, he's in our Discord. He's in our Mastermind Discord, which we have a real estate channel. But Top Gun is our in-house expert. He does wholesaling out of Kentucky. And I'm hoping to partner up with him and do a quad or a triplex. Something like that. And get some investing over there in Kentucky. So we're gonna be meeting up and talking about that. I'm gonna do a trip. Out there. David said, yeah, he remembered it being 120 to 130. Yep. Top Gun plans to invest in multifamily. James, we are not in the NFL. We won't have 200K per year in retirement. You don't have to be in the NFL to get 200K per year in retirement, my friend. You do not have to be in the NFL. Some of these index universal life policies that I'm designing, if we start kids early enough, like for my girls, I'm putting $3,000 a year in. They have the potential of $150,000 plus a year that they'll be able to pull out in retirement from those policies, just by putting in $3,000 a year up until they retire. We're talking 50, 60 years of compounding. Now, that's assuming that we're going to get some good index growth, or average index growth actually is all that requires, and that the insurance companies aren't going to be raising the insurance rates astronomically or reducing the caps, right? But we have to make those kinds of assumptions because we have to start from somewhere. I'm not going to avoid good growth potential just because of what may or may not happen down the road. That really doesn't make any sense anyways. So yeah, there's really good growth potential in these. Now, maybe you and I won't. We won't have $200,000 a year in retirement. Although, we shall see, my friend. We shall see. I'm going to get this option things figured out, and I'm going to make a lot of money in the stock market here over the next few years. That's my hope. And I'm trying to educate myself as quick as I can to make sure that happens. Plus, I'll have some rentals bringing in some income too. What time is it over here? Daniel asks. It is 7:25 where I'm at. Oliver says, Top Gun and James with the Tesla tequila shots. It may be. David, plus we'll be too old to enjoy 200K per year. That might be true. I certainly don't need 200K per year. Let's put it that way. I don't need to make that much to have an enjoyable retirement. Top Gun says, we have a ton of multi-unit properties that you've already started negotiating with owners. Let's go. All right. That's awesome. I'll definitely have to accelerate my timeline in getting over there. Oliver, your kids don't know how well they have it set up. Ahead of the game for sure. Congrats. Thanks. Yeah, my family had never had anything like that, so like I'm not the beneficiary of anything. We've been pretty poor. That changes with me. That's going to end here. So I just need to make sure that, one, I can get this set up, which I've already got it set up with the death benefits that we've got in place. The kids are going to be great. Much, much better off than we were. What my focus is going to be is that they know how to maximize the use of it. And they learn how to move their money efficiently. So that's going to be the challenge, because my kids, they don't like to learn. It's like my favorite thing. I love learning. They don't like it, and I don't get it. And I've got to figure out how to overcome it. Maybe it'll just be with time. Maybe when they get older, they'll be ready to open themselves up to doing some more actual learning. But for now, it's a challenge. So that is going to be my biggest hurdle, is to get them to learn everything that I've learned. Excuse me. Top Gun says that's the goal. Fix it for the next generation. Yep. Yeah, it's nighttime. What is it where you're at, Daniel? David says, plus we'll be invested in Tesla stock on a pullback. Yep. I bought in today. I don't know if you were on at the time, but I bought in. I bought 9 this morning at an average price of $5.56. So remember we sold 12. I sold 12 when you and I sold the other day. I was only able to buy back in. Well, I could have bought back in for 10, but I only bought 9 because I wanted to leave a little bit just in case it went down again. But I bought in at 9. Already up a little bit of money. It had a good day today, so I was glad I bought in. I couldn't just keep sitting on the sidelines. Babber says, Tesla going to 1K in a year? Question mark. Maybe. It certainly could. I'm hopeful to see where it ends up. So I'm still trying to figure out what we're actually looking at between now and December 21st when we're squeezing these indexes, because they have to buy in no matter what the price is going to be. No matter what the price is, they have to buy in. I'm thinking that most of the people buying in right now, most of the other index funds that are benchmarked to the S&P 500, they've got to pick up more shares of Tesla. And they're probably doing that now. They're probably not going to wait until the 21st or the 14th, because this is only going to get worse. The price is only going to go up. So a lot of these index funds are buying in right now, and they're not traders. They're buying in and they're locking in those shares. Those shares are not going to be available when the S&P 500 needs it. When all of those funds that tie to the S&P 500 need it on the 14th and the 21st, when they do their 2 tranches. So there's going to be less shares available each week as we move towards those dates, as all the other funds acquire the shares that they need, and traders continue to buy and sell. But other retail investors, there's so many retail investors in Tesla that are buy and hold, and they're not selling their stocks. So we've got them locking up shares. We've got the index funds that are going to have shares when they're benchmarks. They're locking up the shares. And as the share price goes up, we've got all the options, the market makers that have to hold positions in Tesla stock in order to stay delta neutral on the options. They've got to buy more. So all of these people have to keep buying more and hold it, waiting for that 14th and 21st. I don't know how high up this is going to go. It could go up really high by the time we get to there. Now, it's possible that there's too much of a squeeze. The S&P asks Tesla to do a share offering, and maybe they do that, in which case it could relieve it. It could relieve it, and the price could come back down. I don't know what that would do to the stock. But the higher we squeeze this up before that inclusion, I think the more likely that we may end up getting a share offering that comes out. And Tesla could offer that directly to those to the indexes. I'm hoping they don't do that, because I'm liking what's happening. I'm hoping they don't. but it could be a possibility. Oliver is hoping for Tesla stock to reach over 1K per. He's sitting on over 120 shares with 384 cost average. This will be his retirement or for another investment. Nice. That's really good. 384 is a great cost average, and 120 shares is pretty nice. Daniel, adults like learning for money and growth. That's true. That's true. Good girls finish first. Where are you going to learn about options? We talked about that a couple weeks ago. You've just been investing in shares up until now, but I do think I'm ready to start options. If you join the Discord, I have a stock options education channel. So I'm diving into YouTube. I spend and podcasts. I spend a significant amount of my time watching YouTube videos and listening to podcasts in order to learn about everything that I do. So real estate, stock market, options, insurance, finances, retirement early, the FIRE movement. All of that stuff, I'm subscribed to about probably 70 or 80 podcasts still that I listen to every week. And I have to listen to them at 2.5 times speed, or I would never have enough time to listen to it. And along with that, I watch a lot of YouTube videos because I sometimes like to see things visually as well. So that's where I'm doing all my education. So if you want to take advantage of all of the things that I'm learning, I kind of filter it down for you guys. I put some good videos into that stock options education channel on the Discord, and I talk a little bit about it during these live streams. But if anybody has questions and you ask them in the Discord, I do my best to answer every question in there too. So to join the Discord, you got to use the link in one of these comments. Look at the Streamlabs comment. One of them has the link to the Patreon, and you can get into the Discord that way. I am going to be adding memberships to the YouTube channel too that will also get you into the Discord. I'm just a little slow because I got to develop a video. I got to make up a video for it and figure out how it all works. So, but that'll be another way to get into the Discord at some point. Daniel, kids like things that are fun. They don't care for money. Well, my kids care for money, but they still don't, not enough to learn. Teens and young adults, same time. Oh, you're in California, same time. Okay, cool. Stalin, Acorn Early has stuff for the kids' savings. Yeah, Acorn Early, they cost. I don't like the costs that are associated with Acorn Early. I'm with Acorn. I would much rather do an IUL for the kids than Acorn Early, because Acorn Early is not tax-free. It is after tax. You can't do a Roth for kids because they're too young. You have to have earned income to do a Roth. But we can do an IUL, and that is going to grow tax-free, and they'll be able to access, or it'll grow tax-deferred, and they'll be able to access it tax-free. And it comes with the death benefit, of course. But they'll be able to access it at any point without interrupting that growth compounding. Whereas the money that you're putting into Acorns, if they need to access that, it's going to stop the compounding. It'll stop the growth. Also, anytime you get negatives in the market, it stops compounding. You need a lot more to come back from it. If you lose 50% in the market, you need 100% to get back to even. So that severely impacts compounding. So we get a lot of potential growth in compounding from these IULs just by their nature of no losses in the market when the market goes down. And then, of course, tax-free benefits from being a life insurance product. Let's see. Top Gun likes Tasty Trade for options education. Yeah, they do a pretty good job. And that's you can find the Tasty Trade videos on YouTube. David says, nice, he'll buy Piton on a pullback. Believe this will be the next Tesla stock. Top Gun, a lot of people try and you get lost. Tasty Trade makes it really simple. Yep. Oliver, Tesla stock is the most fun stock in the stock market history. Yeah, it could be. It could be. For some people, I think that might be NEO right now or Xpeng. There's all kinds of stocks that end up getting some major good growth. I only pay attention to Tesla, though, for the most part. I mean, I pay attention to some of the other ones, but Oliver, Elon is stepping on shorts next, applying that pressure. Daniel, he thinks support might be 600 by the end of September. It may get there on Friday. It could get there on Friday. What's a share offering? That means Elon, it dilutes the share price. It means they'll offer more shares onto the marketplace. So currently there's 100 million shares out there. They may add 5 million shares to that. And they'll get paid for it. So it's good for Tesla. It gives them more money in the coffers to keep building those factories. But it does dilute the other shares out there. So hopefully he doesn't do it. It's what they did. Right after the split. It's what they did right after the split. Was they added some more shares to the market. They sold shares to the market at above market price. You remember that? Babber, thoughts on possibility of Biden changing capital gains tax rate? Not a fan of options because it's always short-term capital gains tax, and tax return can be a big headache. Yeah, I think the odds are pretty small. I think the odds are very low that he'll change the capital gains tax rate. For one, he would have to have both houses of Congress, both the House and the Senate. And two, even if he has that, I don't think there's enough Democrats that would be on board with changing the capital gains tax rate. So I don't see that happening. I don't see it happening. Moldy Boat says BlackBerry to 10x, he's thinking. You can get 6-cent options or 8 cents after today. Oh, really? I mean, cheap options aren't always necessarily good. Just depends on how far out they are. And what are the chances that they will go up? So I imagine you see them in a pretty good position. So we'll have to talk some more about that. Put it in the Discord, if you would. Oliver, hope Tesla doesn't do a share offering. The market will not react well. Yeah, I think we all hope he doesn't. Although he may not have a choice if this gets pushed up really, really high. I don't know how the S&P would get out of the jam they're putting themselves in without that. But maybe Tesla won't care. But see, the thing is if he rejects an offer by them to do that, they could always kick him out of the S&P 500. They could always kick him out of it. So that is a possibility. There's a reason firms would play ball when it comes to their requests. I know it's hard to see that happening, but it could. Tall Nubian Shirley. In IBC policies, how often do the companies pay the dividends? Monthly, quarterly, or yearly? Yearly. IBCs, so what you're asking about is whole life policies. We do those with mutually owned companies, and they just pay once a year on whatever your anniversary date is. You'll get those dividends. Moldy Boats. There will be a hint in a tweet before if there's going to be a dilution. Top Gun says, nice. Take a look at Solo 401k yet? Asking BDN. Solo 401ks are great. Definitely recommend checking those out. Oliver thinks 750 by December 21st. Moldy Boat says, price too high, in my opinion, was last one. Oh, was the last one hint. Gotcha. Did he say that? He did that right before that offering? Because that was like right at the height of the split. Right at the height of the split. We shall see. We shall see. All right. It's getting late, guys. What time is it? It is 7:41. We've been going on for quite a while. I'm gonna have to cut this off. I did not get any voicemail recordings for questions today, so nobody wins a Nobody wins a shirt or socks or whatever you want to buy. But if you are interested in winning something from our Teespring Marketplace, our Teespring Marketplace is linked in the description, but it's also right there. If you want to win one of those cool articles of clothing, all you got to do is go to my website, OregonCashflowPro.com, click on the leave a message button. You don't need any special software. You can just leave me a message. Ask me a question that I will play during our Wealthcare Wednesdays live stream, and you'll be able to win a prize. So Top Gun says, ask him a question. He's got enough swag. Top Gun he's going to start a shirt business soon with all the questions he's asked and all the swag he's getting for free. Oh, he said that a week or so before, huh? What am I having for dinner? I don't know. I had a chicken Caesar wrap earlier. Chicken Caesar, or I guess it wasn't really a wrap, it was a pita that my wife gave me right before this started because I was hungry and I needed something quick. So I don't know if I'll go eat some more or not. Probably though. All right, so I'm going to let you guys go. Thank you for joining me. Those were some great questions. Good discussion. We will be back next Wednesday. In the meantime, you guys have a good Thanksgiving. Enjoy the holidays or whatever you do for the holiday, even if it's not celebrating Thanksgiving. And I'm going to play you guys out with some music. See you next time.